You know who the best person is to learn from about investing? The one who's made the most mistakes. Forget all the very successful investors, because in actual fact, it's really only when you make mistakes that you really learn. Isn't that the case, Ivan Lowe?
Yes, exactly. First of all investors have to understand that mistakes are bound to happen in investing. And
nobody's perfect.
Exactly. And most of the time, mistakes are costly. So a lot of investors, what they do is that they will just sweep the mistakes under the carpet.
Meaning what? They cut loss, or they hope that they're going to recover and then try not to think about it.
Exactly. And what happens is they try not to think about it and forget entirely about the mistake itself. But the thing is, in fact, if you can learn from mistakes itself, then that makes you a better investor.
What are the most common mistakes that you come across?
All right, the first mistake is really they expect to win. Most investors come into the stock market, they only expect to win, and they didn't even expect any losses at all. So sometimes when mistakes occurs, and that's where they caught up, and usually clients will begin to call me as a reminder, and they will ask, so what am I going to do with these mistakes, and how I'm going to rectify it.
Right, because some stocks don't always go up, right? There's profit warnings, the trend goes against you, maybe economic data, that sort of thing happens.
Yes, exactly. Yeah, and the other thing that it leads to the next point is that they do not have any investment plan or system to help them be disciplined in doing their investing.
Well, most people have a plan to buy low and sell high. Isn't that enough of a plan?
That's not enough. In fact, what happened was, if you notice, all the successful investors in the world, they all have a plan. And most retail investors, they come to the stock market without a specific plan. All they want to do is, like what you say, buy low and sell high. But most of the time, they sell high. They buy high, sell low.
Yes, or the other joke that I've heard is that you buy low and sell lower, which is probably the worst part.
Yes, that's right.
And what's the third point?
And the third point is that most investors, they do not do this thing called a fund allocation. Basically, what happens is that they take all their entire savings or money and plow it into just a single stock. And when that stock goes against them, and that's the trouble. Okay, so basically, they need to know how to do a fund allocation to park it into proper stocks.
Okay, but let's take each of these in turn, because obviously these are, yes, they're mistakes, but what can we actually learn from them? Let's take the first one, expecting that the market is always going to go up. What does that mean? That you shouldn't be in the market, or that you should constantly put in stop losses, or what's the solution to this mistake?
Okay, the solution to this mistake is very simple. Like I said, the second point is that they must have a plan. Now, the plan comes in because it helps to improve the discipline of the investor. The plan is like a checklist. So they have to check. The first thing is that they have to check, like, what is the business is growing, and how is the business fundamentals, and then we go on subsequently with all the rest of the checklist. Now, most investors, not even a single checklist like this, and what they do is that they will just simply buy based on price. And based on price itself, how do you know whether is it value, or is it undervalue, or is it overvalue? Yeah, that's the problem for expecting just to win from the market is just based on price.
Yes, so how is it that people can avoid thinking that the market's always going to go up? Should they go in other words, with more realistic expectations, or should they almost anticipate that they're going to lose?
Okay, this comes to a very interesting point, is that there's this saying that says that if you protect your downside, the upside will take care of itself. So that's the key reason why when we do investing, we must always be aware of where the mistakes are. And it's just like when you're traveling on a path, there are lots of potholes or pit holes around. But the thing is that if you know where are the pit holes, you will know where you should avoid. So just for what have you mentioned earlier on, this is exactly what the investor should do. Yes, to be aware of the pit holes.
Right. Okay, and resolution to the mistake number 3?
To number 3, fund allocation itself. This basically, we need to have this thing called a position sizing. Basically, an investor, let's say they have $10,000. What are they going to do with $10,000? Are they going to put it all into one stock, or are they going to put it into 10 stocks? And that's what we call diversification. And when we come to diversification, you have to diversify with the right knowledge. Yes, many people, they just diversify simply just because of diversification. And Peter Lynch has mentioned that sometimes if you don't do proper diversification, it becomes diversification.
Right, yes.
Yeah.
Because there is such a thing as over-diversification, isn't there? I mean, if you've now gone from having just one stock to going, and having 20 or 50 or even 100, there's unlikely going to be enough time in the day for you to be able to keep track of all of them, right?
Exactly. That reminds me of one of my friends who he shared with us is that the question is, how many annual reports do you want to read? Do you want to read 50 annual reports? Do you have the time to read 50 annual reports, or do you just want to read like 10 annual reports? If you think that you have enough time to read 10 annual reports, then you just buy into 10 stocks.
Is 10 enough in your experience? Is that the ideal number for diversification?
Yes, generally for me, my portfolio itself consists about 10 to 15 stocks. Yeah, because I find that once it goes beyond 15 stocks, it's very difficult to manage it and also to spend some time to analyze.
Just to keep track.
Exactly.
But you know, there are other ways to diversify. One is in terms of industry. Now, if you look at what the value investors, the famous value investors like Benjamin Graham and Warren Buffett preach, they recommend that you only go into stocks where you fully understand the business. You understand the industry. You have a feel for where the sector is going or should be going. But doesn't that also necessarily mean that you can't be overly diversified, that you should stick to just one or two sectors which you really understand well?
Yes, in fact, this is what we call a circle of competence. So if you are let's say in a medical field, and you're very comfortable with medical field, and usually that's very interesting is that in the medical field itself, there are a lot of businesses within that area. And most people is that they don't study their own industry. They want to go out to other industries to find opportunities. But if they look back into their own industries, right, there's actually a lot of opportunities to find businesses to invest. Yeah, so according to what Warren Buffett says, that you have to invest based on your core competence. And with that core competence itself, it usually benefits you a lot more than if you just go out and look for other industries. Yeah.
And I guess that brings me to the final point of diversification, which is diversification in terms of asset class. Now, clearly, if you are in Singapore, you're like most people, you have a very heavy weighting towards property because of your ownership of an HDB flat or a condominium. Does that mean, therefore, that you should stay out of property stocks and focus on stocks in other sectors?
Not really. In fact, property stocks, personally, I prefer REITs. So REITs is actually part of property stocks. REITs is one thing that is really give you the income, and if you know how to invest in REITs, they basically can feed you a lifetime, and also give you a lot of passive income throughout your investment period. So for me, REITs is probably the right way to go if you want to invest in Singapore for income stocks.
All right.
Yeah.
To wrap up then, Ivan, you've told us about the three biggest mistakes, which of course, having watched this now, you'll remember what they are. The first one being expecting the market to always go up. The second one, not having a plan. And the third, being under-diversified. In other words, only buying one stock. But tell us about your biggest mistake. What was the biggest mistake that you made in the markets?
All right, my biggest mistake was in 2007 when I bought into this company. It was an e-waste recycling company. And in fact, my mistake was I bought it without any analysis, just purely based on assumption, purely based on hoping. During that time, this stock was battered down. The price came down to less than 10 cents. And I invested in it because I was thinking that everyone's using computer and using mobile. So there must be some way for this e-waste, or these e-products to go to. And e-waste recycling company is probably one of them. And that probably leads me to think that it could be a next big industry and also a big turnaround for the company that has been battered down. Yeah. So
what happened? The company went bust.
No, the company still stays right at the bottom.
I see. It's never actually
It's never rise at all. Yes, it is still stuck at the bottom.
Well, that's not such a bad outcome, you know, Ivan. It could have been a lot worse, couldn't it?
It's not too good because it's lost opportunity and actually plowing quite a substantial sum of my capital into it. Yeah.
Right. I see.
So now and
are you still hanging on, or have you cut your losses and moved on already?
Yeah, in fact, I'm still hanging on. The reason why I hang on to all these stocks is it gives me a reminder to remind myself that this is one of the mistakes. So I better not make these mistakes again.
All right.
Yeah.
Well, it's good to talk to you. Thank you so much for coming in. Ivan Lowe from the Value Investing College. He's the head of the Singapore office. He's also the author of these two books, Profit from Stock Tips and Profit from Your Mistakes. And if you look at the website on your screen now, you can also see when the Value Investing College will be represented in SIAS's Singapore Investment Week.